you're going to see that there's a bunch of yellow tabs at the bottom here. And before the first yellow tab, there's this one that says transactions. Okay, so it's just a list of a bunch of transactions. And what we're going to do is basically apply these rules that we just learned, and we're going to do a bunch of journal entries, okay? For all these transactions, you can see on April 1st, this company received cash from issued common stock, okay? So you're going to go through, you're going to figure out what accounts were involved, what type of account they are. Are they going up or down? Are they debited or credited? And then, this makes it a little easier. There's drop downs and stuff to pick the accounts. So the first step is to do this enter answers 1 tab. Okay, this first tab, and that's what I did was I took these transactions which are on the different tab, I just copied them, and then I pasted them right here so I could have them in one sheet. So I would do that if I were you. It'd make it easier. Okay, so I'm gonna turn on the lights, and we're gonna work on this for a good amount of time today. Okay, so on April 3rd, the company paid cash for land. Is cash going up or down? Down, right? Cash asset going down, that's going to be a credit. So I'm going to credit cash, and I'm going to debit. What am I getting for that land? Or sorry, for that cash? I'm getting land, right? So look, I think there is some confusion. Again, you need to make sure that you're understanding the difference between buying an asset and paying for an expense. Okay? Just because cash leaves your company doesn't mean that there's an expense. Okay, this is a case where you're trading one asset for another. You're trading cash for land. Okay? If I had been paying, whatever salary expenses, this would also be a debit. Okay? This could also be a coherent journal entry because expenses are debit normal. If you go look back at how what is debit normal, what is credit normal, but in this case, it's not a expense account. It is a land. And we're just trading one asset for another. Okay? So you need to understand that just because cash leaves doesn't mean it's an expense. Okay? We're also spending our cash to buy other assets. And we're just trading one asset for another. Okay. Next one. We purchased office supplies on account. Okay, so I'm receiving office supplies, and office supplies are what? An asset? What are they? Yeah, they're an asset, right? Let's just not play that game. 1250. It's an asset. Now, if I had paid cash, hypothetically, this would be a perfectly valid journal entry, right? Because cash is going down and I would credit it. However, I'm not, and I have accounts payable, okay, which is also a perfectly valid journal entry because it's a liability and liabilities are credit normal. Okay, so let's just now post these two. Okay, so land, debit, 225,000. So I go here to land and make sure I'm on the debit side. I debit 225,000 to land, and then I credit 225,000 to cash. And you can see it's automatically doing it. It's calculating my balance for cash automatically. Okay? And then the other one was office supplies, debit, 121,250. So office supplies, debit. And then where is it? Accounts payable, credit. Okay, so you can see here in this little debit credit check, we're balanced. Right? This little corner right here, you can see that we have a balance. Oops. We can see that we're balanced. If I had messed up, okay, let's say I'd put the credit to account payable incorrectly, you could see that it would have thrown this balance off, right? So this spreadsheet is set up in a way to help you avoid a mistake. Okay? April 6th. Let's do a couple more. We provided IT services for a client and collected cash. So cash obviously is one of the accounts. Is it going up or down? Up, right? I collected uh, revenue from a client, 12,000. And I kind of gave away. What is the other account involved? I just kind of said it. What did I do in this transaction? I provide service, right? So what do we call that when we earn service revenue? Correct. Okay, so let's post this. Debit to cash, credit to service revenue. Okay, so we're still balanced. Okay, April 7th, our transaction 5. Redmond provided IT consulting services for a client, and the client will pay us in the future. Okay, so it's going to be the same credit. It's service revenue. We're doing kind of the same action as before, where we're providing services to our clients. However, they're not paying us cash right away. So if we did collect cash, it would just be pretty straightforward. We would debit cash just like we did in the last one. But they're not paying us yet. What is it called when someone owes us money? Accounts receivable. What kind of account is that? Is it an asset, liability, revenue, expense? What is it? Who thinks it's who thinks it's an asset? Who thinks it's some other kind of like one of the equity accounts? It's for sure, yeah, it's an asset. Okay. Okay. So then we post it. Accounts receivable, 14,000 debit, service revenue, 14,000 credit, and we're still balanced. Okay, let me do one more. We paid cash expense on April 10th. Salaries 8,000 and office rent 5,000. So this is our first little taste of a transaction that is going to have more than two accounts. Okay? So what are the three accounts involved here? There's three. Salaries, expense, rent expense, cash. Those are the three accounts. Okay, so cash is going to go down, right? This is now money out the door. Okay, so I already know it's going to be a credit. And what's the total? It's 13,000. So I already have the cash part of it done. Okay, and then what do we say? Salary expense, and we said rent expense. Okay, and salaries is 8,000. Is that right? Is that right? Okay, so again, we're following our cardinal rules of journal entries. There's at least two, and the debits equal the credits, right? Okay, so let's just now post this. So salary expense, now I'm going to finally be into this section here. So salaries expense, 8,000, rent expense, 5,000, and I'm making very sure they're on the debit side because expenses are debit normal. I'm making sure I'm posting them in the correct side of the T account. And then cash, and I still see that my debit and my credit uh, totals are balanced. Okay, so I think we're caught up with the posting for all of these. So let's see. This one, transaction 7. So we paid $750 on the accounts payable created. Okay, so in transaction 3, we have this accounts payable This is the amount that we owe, okay? We're now going to pay off some of that. Okay, so I'm actually going to do it a little backwards just to illustrate my point. So this 12,000, or sorry, 1,250, what should it be after I make $750 payment? What should the balance be? How much would I owe? 500, right? The way to do this is I have a credit balance. If I just debit the amount of my payment, you can see that the balance for accounts payable goes to that correct amount I still owe. Okay? So I already have half the journal entry. I'm going to have to debit accounts payable. Okay? What did I use to pay off this debt? What do you use to pay off your debts? Your bank account balance, right? Your cash. So cash is going to go down 750 bucks. Okay? So let me post the other side of that. And I'm making sure that on cash, I'm making sure it's on the right side because that's the credit side. Okay, any questions on that? Everyone got that? Okay. All right, let's keep going. Um, we collected $3,000 of cash. Okay, so obviously it's going to be a debit to cash. I already have half the journal entry done, right? Cash is going up because I'm collecting it. And it's from this client from transaction 5. So if we look up here, there is a receivable that was created, right? We did this service for this customer. We recognized the revenue at that time, right? But they're deferring the payment, right? So again, I mentioned this last time, I'll say it again. We've already recognized the revenue, okay? We've already kind of attributed our equity to this, like we've kind of boosted our net worth of our business already, right? Now it's just a matter of collecting the cash. We're just going to trade one asset called accounts receivable. That's going to disappear. And we're going to get cash in the place of that because in this transaction, that business owed us money. So we had this asset called accounts receivable that was created. They no longer owe us that money, right? They're paying us off. So that asset is going to disappear. It's going to go away. And in its place, we're going to actually get the hard cash. Okay, so I have two assets that are involved, cash and accounts receivable. One is going up, cash is going up. One is going down, accounts receivable is going down. And it was for 3,000. Now they didn't pay us off everything. They're just making a payment, right? So if I just post this, 3,000 debit to cash, 3,000 credit to accounts receivable, we now have the balance of how much they still owe us of 11,000. Okay? So that's kind of the beauty of the system too. All you have to do is just keep track of the payments and the balances will just automatically update to what their most current status is. Okay? Okay, so next. Um, is it this one? Yeah. Paid $8,000 salary. Okay, on April. Oh, wait, did I skip some? Okay, yeah. Um, paid dividend 2,500. Okay, so I already can just put in the amounts. Okay, look, I know it's going to be a debit of something 2,500 and a credit of something for 2,500. Okay, the easy one is cash. Cash is going out the door. Okay, cash is going to be the credit. Agreed? When you pay a dividend, the cash from your business is going to diminish. The cash balance of the owner's personal bank account is going to go up. We call that a dividend. Okay, so dividends, that's a debit normal account. So it makes sense that when we pay a dividend, we debit this account called dividends. Okay, so this is a coherent journal entry in line with our rules of debits and credits. So then I'll post this. How much was it? 2,000? 2,500. So I'm going to credit cash 2,500, debit dividends 2,500. And again, I'm making sure that this debit credit balance is maintained, and it is still. Okay, so let's keep going. On the 18th, we prepaid office rent. Okay, so uh, we just talked about this, right? Prepaid rent. What kind of account is that? There was a debate whether it was an asset or an expense. What did we determine it was? Asset. Okay. So when we have this new asset called prepaid rent, is that a debit or a credit? Debit. Okay, so we're going to debit prepaid rent. What are we paying the rent with? What is this? What are we giving to the landlord? Cash. So our cash is going to go down, right? So we're going to debit prepaid rent, credit cash. And how much was it? 15,000? Okay, so uh, I'm going to post that. So cash is going to be a credit, 15,000, and this prepaid rent asset is our debit, 15,000. Okay, so this one, Redmond paid 8,000 in salaries. Okay, so this is pretty simple. What are you paying the salaries with? Cash. Okay, so is that a debit or credit to cash? Credit. Cash. Debit is, we already saw this up here, remember? So this is the same, salary expense. Okay, so I'm going to post it here. Salary expense, it's getting another debit, 8,000. Cash gets credited, 8,000. Okay, we purchased a building. Okay, so we're purchasing a building and we're not paying any cash for it. We're taking on a loan for the entire purchase amount. Okay, so the building, what is that? Is that an asset, liability, revenue, expense? What is it? Asset. We're we're receiving it. So is that a debit or a credit? Debit. Okay, so 520,000 debit to building. Okay, and we know there's a credit 520,000. What should it be to? Notes payable. Okay, and that makes sense, right? Notes payable is a liability. We'll have a new liability. It's going up, so that's a credit because liabilities are credit normal. So building debit 520,000. If I go to my liabilities, I see notes payable credit 520,000. And now, okay, so when you see these like little number signs, it just means that the column is not wide enough to display the number. Okay, so what you can do is go to up here, you can drag the column a little wider. You can also just double click on the border and it will automatically resize the column so that it can display. Okay, so we see that we're still balanced. Okay, okay, so this one is interesting. Okay, so in the first transaction, our company gave common stock in exchange for cash. That's the most common way that owners will kind of uh, get ownership in a company. In this case, the owners, someone is trading furniture for ownership. Okay, but the furniture has value. It's $25,000 worth of furniture. So it's essentially like in this first transaction, we have some asset, cash being debited because our company is receiving that, and our company is issuing new common stock. So it's the same thing, except we're going to debit a different asset. We're going to debit furniture, 25,000. In exchange, the owner is getting that value in common stock. Okay, so then if I go here, common stock, another 25,000 credit, and we're getting furniture, $25,000 worth. It's a debit there. Okay, cell phone bill. Okay, um, $1,100, and we're going to pay this. So uh, it's basically uh, it's telling us to use utilities payable. So we already know one account. So if we have this new liability, should that be a debit or a credit to utilities payable? Who thinks? Well, what is utilities payable? Is it an asset? Is it a liability? It's a liability, and when liabilities increase, what are they? Is that a debit or a credit? Credit, right? So utilities payable will get credited. What should we debit? Yeah, expense, right? This is the cell phone company is sending us this bill because we've used a cell phone, and that's an expense for my business, right? I get no future benefit. I've already used the cell phone service, okay? So that's an expense. That's the definition of an expense. Okay, so we're going to debit utility expense, or what is it? Cell phone expense, utilities expense, and we're going to use utilities payable of 1,100. Okay, so again, this transaction, number 15, is the same exact transaction as this one. Okay, salary is expense, and you're paying them. It's not going to be, there's no liability here. You're actually paying them the cash. So I can just copy and paste, or at least like look back. Salary expense and cash, 8,000. Salary expense and cash. Okay, so now I'll post this. I'll go to my salary expense. Actually, I think I did this. I already did this part, and I did this. Okay, so I think I've already posted these. I must have just, that's where we ended. Okay, the next one. We meet our clients who pay us in advance. Okay, so we have not actually performed any services. We haven't done anything for this client yet, but they're giving us money. Okay, so uh, what are we receiving? What account is that gonna involve? What are we getting? Cash. Okay, so is that gonna be a debit or credit? Debit, right. So 22,000, we're gonna debit cash. Now, if we had done something, we would have earned revenue, so we would have done 22,000 credit to service revenue, right? But as the transaction stated, we haven't actually done anything to earn this. Okay, so it's if you haven't earned it, it's called unearned, right? Unearned revenue. And this is a type of liability, right? This is something we owe to this client. We owe them $22,000 of services. They've already paid for it. We just now have to deliver those services. So until then, it's going to be a liability. Okay. And later we're going to see what happens when we actually do the work for them, right? We're going to convert this liability. We're going to reduce the liability and record a revenue. Okay, so you can maybe already see how it's going to play out. If you're going to reduce the liability, it's going to be a debit to unearned revenue, and then we're going to credit service revenue, right? So that will have the effect of reducing that liability. Okay, but we'll see that later. We're going to kind of build upon what we were learning, but I'm just giving you a little preview. Okay, so the last one. Okay, actually, did I post this? Probably not. Okay, so cash, I'm going to debit 22,000. And then I'm going to go to unearned revenue, credit 22,000. Okay, and then last one. We performed. Okay, so this is a pretty simple one. We're just receiving cash for services performed. So I think we've seen that already several times. The amount is 16,000. We're receiving cash, and it's for services performed. So we've earned this revenue. Okay, so I'll do post this now, 16,000. And then service revenue, 16,000. Okay, so if I've done this correctly, I'll see that my debits and credits match, and they do. This next tab is the trial balance. Okay, you can see this debit and credit total. They're balanced, and all of my accounts are displayed here. Okay, they're all so again, just to make sure, this cash, 438,750. Where is this coming from? Well, if I go back here, I have all these transactions that have affected cash. The balance is this, right? It's a debit balance. We did this, practice this, where we have a bunch of debits and credits in a T account, and we calculated the net balance. Okay, so this 438,750 is after all these transactions, after this month, the total cash balance is 438,750. So now we're taking this balance and we're just moving it to this set of all of our accounts with their respective debit or credit balances. Okay, we're just seeing what the balances are now at the end of the period. And you can see when we do this, so again, just to show you one more, this 11,000, where is it coming from? It's coming from right here, accounts receivable. We had 2 transactions affecting it, and the balance is $11,000 debit balance. So you can see in the trial balance, that's where this 11,000 is coming from. Okay, so we just go and just do this for all of them, being very careful to differentiate between a debit balance and a credit balance, because like notes payable, 520,000. So go to notes payable, it's a credit balance. So I'm making sure that on my trial balance is showing up as a credit. Okay, and if we do this correctly, and we've done all our transactions correctly, the trial balance will have a balance here.